Hello friends, welcome to Learn Easy. We will discuss activity ratios in business. If you want to know the relative efficiency of companies in the same industry, we have to analyze activity ratios. Now, what are the activity ratios? Activity ratios are financial ratios that measure a company's efficiency in managing its assets. It is a measure to understand the stability and utilization capacity of the business by using the company assets, whether fixed or current. These ratios provide valuable insights into how effectively a company utilizes its resources to generate sales and profit. Stock analysts examine several activity ratios that indicate how efficient a company is at turning its assets into revenue. Activity ratios are most useful when employed to compare two competing businesses within the same industry. The most commonly used activity ratios are: first, accounts payable turnover ratio; second, accounts receivable turnover ratio; third, average collection period ratio; fourth, fixed asset turnover ratio; fifth, inventory turnover ratio; sixth, total asset turnover ratio; and seventh, working capital ratio. Accounts payable turnover ratio is calculated by dividing the cost of goods sold by the average accounts payable. It provides a picture that how quickly a company can pay off its debts. A high accounts payable turnover ratio indicates that a company is prompt in paying its suppliers, which can help maintain good relationships. When accounts payable turnover ratio is calculated quarterly, the number of days used is 90, while a full year is 365 days. The formula for calculating accounts payable turnover ratio is: accounts payable turnover ratio is equal to total purchases divided by average accounts payable. As per example, suppose a company made credit purchase of rupees 12 lakh in 2025. Its beginning accounts payable balance for 2025 was rupees 2 lakh, while its ending balance was rupees 2 lakh 80,000. So, its average account payable balance is equal to rupees 2 lakh plus 2 lakh 80,000 divided by 2 is equal to rupees 2 lakh 40,000 for the year 2025. So, accounts payable turnover ratio is equal to rupees 12 lakh divided by rupees 2 lakh 40,000 is equal to 5. The ratio 5 indicates that the company's accounts payable balance has turned over 5 times during the year 2025. Second, accounts receivable turnover ratio. Accounts receivable turnover ratio reflects how quickly a company collects payments from its customers. In other words, this ratio measures how quickly your customers pay their credit accounts. A higher accounts receivable turnover ratio indicates that a company is efficient in collecting payments and has good credit policies in place, while a lower number indicates slower payment or poor credit or collection policies that may need to be reviewed. Accounts receivable turnover ratio is equal to net credit sales divided by average accounts receivable. A high accounts receivable turnover ratio indicates that a company is efficient in collecting payments and has good credit policies in place. As for example, suppose a company's credit sales for the year 2025 was rupees 12 lakh. Its beginning accounts receivable balance was rupees 1 lakh 10,000 and ending balance was rupees 1 lakh. So its average accounts receivable balance is equal to rupees 1 lakh 10,000 plus 1 lakh divided by 2 is equal to rupees 1 lakh 5,000. So accounts receivable turnover ratio is equal to rupees 12 lakh divided by rupees 1 lakh 5,000 is equal to 11.43. This means that the company's accounts receivable balance has turned over approximately 11 times during the year 2025. Third, average collecting period ratio. Average collecting period ratio is equal to days in period into average accounts receivable divided by net sales. To find out how many days a company is taking to collect its accounts receivable balances, the average collection period ratio will give the picture. As for example, if a company's net sale is rupees 12 lakh, beginning accounts receivable balance is rupees 1,10,000 and ending accounts receivable balance is rupees 1 lakh, then its average accounts receivable balance is rupees 1,10,000 plus 1 lakh divided by 2 is equal to rupees 1,05,000 in year, that is 365 days, and net sales is rupees 12 lakh. So average collection period ratio is equal to 365 into rupees 1,05,000 divided by rupees 12 lakh, which comes as 31.94. So the company takes an average of 32 days to collect payment on an invoice. The fixed asset turnover ratio measures the ability of a business to generate sales from the fixed assets. The ratio focuses on a company's efficiency in generating sales using its fixed assets such as property, plant and equipment. So, fixed asset turnover ratio is equal to net sales divided by average fixed assets. Suppose a company's net sales for the year 2025 is rupees 12 lakh. The beginning fixed assets for the year is rupees 1,80,000 and the ending balance for the year is rupees 2,10,000. So, average fixed asset balance is equal to rupees 1,80,000 plus 2,10,000 divided by 2 is equal to rupees 1,95,000. So, fixed asset turnover ratio is equal to rupees 12 lakh divided by rupees 1,95,000 is equal to 6.15. So, the company's every rupee in fixed assets is earning rupees 6.15. A higher fixed asset turnover ratio is considered desirable for a prosperous company. If fixed asset turnover ratio is found too low, it indicates inadequate sales coupled with improper utilization of the company's fixed asset. Fifth, inventory turnover ratio. Inventory turnover ratio measures how efficiently a company manages its inventory. It is calculated by dividing the cost of goods sold by the average inventory value. So, inventory turnover ratio is equal to cost of goods sold divided by average inventory. The average inventory can be obtained from beginning and ending balance sheets of that period. The cost of goods sold can be found on the income statement. As for example, suppose a company's beginning inventory for 2025 is rupees 2,10,000 and ending inventory is rupees 1,80,000. The company's cost of goods sold for 2025 is total rupees 12 lakh. So, the average inventory is equal to rupees 2,10,000 plus 1,80,000 divided by 2 is equal to rupees 1,95,000. So, inventory turnover ratio is equal to rupees 12 lakh divided by rupees 1,95,000 is equal to 6.15. The result above indicates that the company's inventory turnover for 2025 was 6.15. It means that inventory levels turned over 6.15 times during the year. This implies that the company is efficiently utilizing its inventory to generate sales. A good inventory turnover ratio is between 5 to 10, while a low ratio of less than 5 indicates poor product demand or weak sales. Sixth, total asset turnover ratio. Total asset turnover ratio evaluates a company's ability to generate sales using its total assets. It measures the company's efficiency in utilizing its total assets to generate revenue. It is calculated by dividing net sales by the average total assets. So, total asset turnover ratio is equal to net sales divided by average total assets. As for example, Suppose net sales for 2025 is rupees 12 lakh. A company's beginning total asset for 2025 is rupees 2 lakh 30,000 and ending total asset is rupees 1 lakh 70,000. So the average total asset is equal to rupees 2 lakh 30,000 plus 1 lakh 70,000 divided by 2 is equal to 2 lakh. So total asset turnover ratio is equal to rupees 12 lakh divided by rupees 2 lakh is equal to 6. It indicates that each rupee of assets the company can generate rupees 6 in sales. A result less than 1 indicates that the assets are not being used properly, while a higher number indicates that assets are being used to generate income. Seventh, working capital ratio. Working capital ratio is equal to net sales divided by working capital. Again, working capital is equal to current assets minus current liabilities. The ratio indicates how efficiently a company currently uses its working capital. As for example, suppose for the year ending 2025, a company's current assets is rupees 1,50,000 and current liabilities is rupees 70,000. So working capital is equal to rupees 1,50,000 minus 70,000 is equal to rupees 80,000. Let net sales of the company is rupees 12 lakh. So working capital ratio is equal to rupees 12 lakh divided by rupees 80,000 is equal to 15. The result shows that for every 1 rupee of working capital, the company have rupees 15 in sales. A high working capital ratio indicates that the company can use both short-term assets and liabilities to generate sales. A lower working capital ratio indicates bad debt or sluggish inventory movement. Let us conclude. Activity ratios are used to compare the relative efficiency of companies in the same industry. These are used by outsiders or stakeholders to analyze the company's fundamental strength. The activity ratios are also used by the management to track the business done by the company and accordingly assist in preparing a forecast for the future. These are monitored over time to find out whether a company is running in desired efficiently. That's all. Thank you for watching the video.